Hello, my name is Michele, and you're listening to Profit is a Choice. Joining me on the podcast today is Mark Willis. He's the owner of Lake Growth Financial Services, which is a financial firm in Chicago, Illinois. Mark is going to lead us down this journey of really understanding our financials better. And you know that I love that. So today we're going to be looking at how to really be the bank for our company, what it means to take back the ownership and the money and the lending instead of being a slave to the banks or, to somebody else holding a note over our head or having so much debt that we don't know how to get out from under it. And so Mark is going to share stories. He's going to give us some methodologies and mindset changes so that we too can be in full control of our finances. Every day, empowered entrepreneurs are taking ownership of their company financial health and enjoying the rewards of reduced stress and more creativity. With my background as a financial software developer, owner of multiple businesses in the interior design industry, educator, and speaker, I coach women in the interior design industry to increase their profits, regain ownership of their bottom line, and to have fun again in their business. Welcome to Profit is a Choice. Hey, Mark, welcome to the podcast.
Michele, so glad to be on. Thanks for having me on.
Oh, it's a pleasure. In our pre-conversation, I said to you, you had me at financials. Like the minute somebody sends me in any kind of, hey, I think we could be a good fit for the podcast. I guess now everybody listening knows what the key word is to get my attention. Money and financials is going to make, of course, my antenna go up and go, all right, I'm ready to dig in and look to see. So, Mark, before we even get started talking about the topic and the ideas that we want to put forth today, share with our listeners, if you can, a little bit about you. We're all listening about how you got to where you are, because rarely is the offering that we have today the one we started with or the business. So I'd love to just share some of your journey with our listeners before we jump in.
Sure. Yeah. Thank you. Well, you're exactly right. Things didn't start the way they are today for me or my family or our business today. So I work today with real estate investors, business owners of all kinds, and even some NFL Super Bowl champions. But most people I work with are just looking at having a bit more certainty or control over their finances, their cash flow, and their business. I'd say maybe 65, 70% of our business are either business owners or real estate investors or both. And the rest would make up your W-2 day job types. We love them all. It's like children. You can't pick a favorite client. But I am especially drawn to the ethos of the entrepreneur because I am one myself, and I think they are going to save the world in many ways. The entrepreneur can save the world if he or she knows what they're doing. So that's been what I do today. I work in an advisory role. I'm a certified financial planner and work with clients all around the country to help them meet their financial objectives for their family or their business without taking a bunch of unnecessary risks. And in particular, one of the strategies we specialize in is helping them become their own source of financing, which we might want to talk further about. But to my journey, I started out not knowing really what the backside of a penny looked like because I was in so much debt. I couldn't rub two pennies together, that is. We graduated in 2008, my wife and I, with $120,000 of student loan debt. And worse than that, we had no plan to pay it off. We just didn't have a plan, never paid attention to money. And we graduated, as I said, in 2008, a great year to be looking for work, by the way. And it became it was funny because these student loan companies, they actually wanted to be repaid. And that kind of shocked me. And it got me focused on this thing called money for the first time in my young adult life. But as I tumbled down that rabbit hole, I began to realize there were some major problems with my training, my teaching that I had been given around money. One in particular was how to pay off debt and how to make major purchases. I started my debt payoff plan just throwing money at the problem. Just throw money at it, hope it goes away, pump as much money into all this debt that I had as possible. And about halfway through my project of paying off all that debt, I realized that I was throwing away the best dollars of my life because I was as young as I'd ever be, just like all of us today, is the youngest we'll ever be, ever again. And I was throwing money into this hole called my debt, and I'd never see that dollar grow for me ever again. It was now going into someone else's retirement plan. It was going towards someone else's vacation or dream job or whatever what they were trying to do. It's no longer in my wealth system. It's now in theirs. And that got me angry because I realized I had created this hole for myself and my young family. 120 grand is not a small amount for a, mid 20 something. But worse was when I calculated what that 120 grand would grow to had I not had the debt, but could have saved that money instead, it was massive, nearing 7 figures over your lifetime. And that really got the fire under my pants to get up and try something better than debt-free. That became my mantra. I want to be better than debt-free. And so as a financial planner now, I help people become better than debt-free. I have since paid off my debts, but more than that, I bought them back by becoming my own banker, paying the student loan snakes off, and actually collecting that money from myself to get a profit off the debt that I once paid to somebody else.
I love it. I think about one of the things Mike Michele says, we both talked about a little bit about profit first earlier, but one of the things he says, and I've heard other people say it, so I don't think it can only be attributed to him, is that we have to fall in love with saving more than we fall in love with spending. And I do think that, I feel for you and for the young people that have student loans. I know there are a lot of our listeners that have student loans because a fair number of, the people I coach have student loans. And they're into their 30s and 40s, and some even into their 50s, still paying off these student loans. And it feels like even some of them are like, even if I never get it paid off, but it feels like such a weight. It is such a burden to carry. And you feel like you can't make the next big life decision because this is weighing you down. And just really, I love that, getting angry, because that's what spurs us on to make a change, is frustration, anger, irritation. Because if we're happy with the way something's going, why would we change it? But if we don't understand, like you said, the concept of how it works and the fact that, I'm sure you probably did the math, Mark, but the $120,000, by the time you paid it back, how much were you going to have to pay back if it was extended?
Oh, yeah. It was almost double the price to spread it out like that. Yeah.
If not more,
yep,
if not
right.
more, right?
Mm-hmm.
And so I think sometimes when we're taking out these loans, whether it's credit card loans or that type of loan, unless we have a plan to pay it back, and we have a plan for it to create some return on investment, not just a consumption, right? Mm-hmm. Not just I'm just consuming and building debt, which is one type of debt, but even going into debt to build something that has a return on investment, that's a different type of debt. And mm-hmm. they have to have a plan and a strategy each to be dealt with. Let me ask you this. What did you go to school for? Did you go to school for financials and to be a financial planner?
No. I jokingly say I went to school for seminary. I got an undergrad in ministry and then a graduate degree as a master's of divinity, which means you could be a preacher or minister or pastor or something.
Sure.
I never saw myself in that role, in that traditional kind of role behind a pulpit type deal. And I jokingly say my favorite book of the Bible is the book of Numbers, because I was always very much a numbers geek, but money was not on my radar. Actually, there's a lot of shame around money. We can get into that if you want. But the key was, like, for me, I never even in a master's context to lead a congregation, there was not a real course on balancing a budget.
Yep.
Or even more important, managing the relationships of the leaders of a community or a nonprofit, or in this case, maybe a business. How do you talk about money to somebody who has a very different mindset, worldview, whatever? And how do you negotiate a balance sheet with a team of your peers or colleagues or shareholders of a business? And it was just surprising to me that I had gone through all this education and had no, real theology of money, but even more than that, a practice of money that I could feel like sane with and just running my normal bills as a young adult.
Oh gosh, you're so true. I remember when my husband and I get married, I grew up in a family, because think about this. I mean, this because you work in this industry, right? You're constantly doing probably seminary degree has served you well. I can promise you, if you're working with husband and wife teams on
That's
how
right.
they're going to handle their money, because it is, from what I understand, one of the number one reasons of divorce, even above infidelity, is
That's
money
right.
management issues. It's huge.
Oh, yeah.
And when my husband and I got married, we came from very different money backgrounds. In my home, you paid everything in cash. I mean, I'm in my 50s, so we didn't have all the ATMs and the credit card. All that wasn't there and used the same way. So I grew up in a very cash friendly home, as did he. In my home, though, my dad was very analytical, so everything was budgeted and written down. And I can remember it was almost like doing little tea accounts sitting at the kitchen table. So I understood money really deeply. And I understood I would fight for 2 hours to get down to the penny when that bank statement came in and I had to balance my bank accounts. My husband, on the other hand, his mother worked at the bank. So when his bank statement came in, his rule was, I'll go a week without spending any money and I'll call my mom and she'll tell me how much is in the account. That was how he balanced. You can see these were not the same. And so when we got married, the first thing we looked for was, how do we start merging our money, merging our accounts, merging our financial planning and goals? What's important, what's not, what's of value, and how do we spend, like our framework, right? And we went to our church and said, can somebody help us? And I'm trying to think, was it like a Ron Blue? I think there was a Ron Blue money management program or something. And they brought in a program and did it because nobody knew how to manage money. And what's been interesting is years later, I've had so many young families come to me and just high level sit at the kitchen table, bring their bills, bring everything. Let's just lay it on the table and let's just look at it and see what this might look like, what's important, what's not. And so what I do find interesting is that many of us in our home recognize the need so acutely, right? Because it's a survival mechanism in our home on how we're going to steward that cash or the money that's coming in. But sometimes we don't think about it in our business the same way. You made a statement a minute ago, and I'd love to just expound upon it for a moment. You said, I believe the entrepreneurs are the backbone. They're like what we have going for us in the future, if they know what they're doing. All right. Tell me what it looks like for an entrepreneur to know what they're doing.
Well, I want you to imagine an airplane. All right. And let's say your airplane can fly 100 miles an hour. It's a little prop plane, let's say, and it can do 100 miles an hour without any wind or otherwise. But we all know that airplanes always fly in an environment. Okay. There's never a time when they're in a vacuum. They're always surrounded by the context. And that context might be a 200-mile-an-hour headwind coming right at your face. Now, tell me, Michele, you're pretty good with numbers. If your airplane can do 100 miles an hour into the wind, but that wind is pushing on you at 200 miles an hour, which direction is your little airplane going to fly? Backwards. Yeah.
Yep.
Yeah. No matter how hard you push. Most people's financial lives are all about, how do I rev this airplane's engine to get a little bit better rate of return on my 401k, or get a little bit better rate of return on my IRA, or push a little more risk into my business to make it go 105 miles an hour. Meanwhile, the banks, the credit card companies, taxes, they are the environment in which our money lives. And no matter how hard you push, your plane cannot fight against the overall prevailing interest rates or tax rates, inflation rates, and more. So most people think the best thing to do is to land that plane and just save up and pay cash for everything and wait for the wind to die down. And that is better than fighting into, I had a guy one time, he made a really good income, $250,000 a year or so for him. He was a doctor, but he was spending 80 grand a year just servicing all of his debts. Boat, couple of houses, couple of cars, his medical loans from student loans, all that equaled 80 grand a year in interest payments, Michele, interest payments. That's a third of his income just servicing debt. Now, he was happy with his 401k getting like 10% last year. But think about that. That's a 10% non-guaranteed pre-tax rate of return in your 401k. Meanwhile, you have a guaranteed negative rate of return of 30% with after-tax contributions to your credit cards and your boats and all that stuff. Now, doesn't matter how much he does in his 401k, his little airplane's flying backwards, right?
Yeah.
So what can you do? What can you do? Yeah, go for it.
No, so what I was going to say is I think some of that comes down to a conversation around value and tolerance, right? He clearly had a value. I'll put it to you this way. My husband is he's willing to take more risks than I am. I'm much more on I'm going to take extremely calculated risks. So I'm going to sit down and go behind my poor financial planner. I love him. I'm going to sit down behind him and I'm going to be calculating and I'm going to say, hey, help me understand this calculation. And where did you get that number from? And okay, I know how we plug that in. And then I'm going to go with it. And 9.9 times out of 10, I always agree with them, right? Almost always. But I have to understand it. My husband is like, go, yeah, have it. He's a bit more freeform about it. So our tolerances are very different from a risk. But what we also value has shifted over the years. I'm just going to be really honest and tell you, even as whether we're talking business or home, I have been having a personal awareness is what I'm going to say. I'm not struggling, but I have this awareness that is creeping in more and more and more. And listen, I'm all about making money just like you are, but certainly making it conscientiously with integrity, doing it the right way. But I am watching the consumeristic beast that is eating us up. I mean, eating us up. Like, and we're not even aware of it. Like I can say sometimes I've not even, like I watch certain influencers, TikTok. I'm not a TikTok fan, but Instagram, and you're watching them and they're going, oh, here's the new shirt, or here's the new pair of pants, or here's the new toothpaste, or you now need to be using this. And oh, don't tell me you're using that. But it's like every day. And the other day I was sitting there and I was watching one of these influencers and I thought to myself, how much must you have in your closet? Like, how much are you changing clothes? You can't have that many pair of tennis shoes. This is like, you couldn't even wear them every day. Like, this is just ridiculous. Like, why are we throwing good after good? And then I go back and look at my mom and my dad and my grandmother, and, they're holding on to things from the 1920s and they're like, it's still useful. And I'm still like, we've gone to this crazy, just consume, which causes us to have to earn more, to pay more, to have nothing when it's all done. I mean, it's just this weird mindset, right?
Mm-hmm. Yeah, that's right.
And I think that sometimes it's not until you see it blown up and kind of into a crazy form that you go, aha, that's weird.
Well, that's true. And it conforms with what I'm seeing in my conversations with folks when I first meet with them. And in 1940, according to the U.S. Commerce Bureau, Americans on average saved almost 30%, 27% of their income. 27% of their income. Wow. Today, we pay about 36% of our income to interest and debt payments and servicing debt. We used to have about 5-6% of our money going to debt in 1940. Now we have 36%. So we have 10 times as much debt that we're servicing. Mm-hmm. And our savings rate today, again, this is as of just a month ago, we are saving about 2.8% of our income. So that's for our retirement, but it's also for our kids' college. It's for our emergency fund. It's for our medical expenses, our leaky roof. Is 2.8% of our money going to cover it? Of course not. This is why credit card balances are at their highest. This is why banks are the most profitable business in all of human history. There's a great book on the topic. It's called Debt, the First 5,000 Years by David Graeber. The title is the best part of the book, in my opinion. Debt, the First 5,000 Years. That 4-letter word, Michele, debt, probably has caused more divorces, broken relationships, suicides, I hate to say. That word, I mean, the word debt is a negative, but it's also, check this out, it can be the most profound shift in your thinking as a business owner or a family member when you control the environment where your little airplane is flying. You can go from a headwind to a tailwind. And if you've got a 100-mile-an-hour airplane getting pushed by a 200-mile-an-hour tailwind, well, that is a massive change in direction right there. You can go a lot faster when you have the environment under your control. Now, most people think it's impossible to control the banking function, the interest rate function, the tax function, but I'm here to say it's totally possible. I do it myself. I've used my own tools and accounts to pay off my debt, but actually buying it back and being my own banker, in essence, gives me the control that I had otherwise outsourced and rescinded over to banksters, credit card companies, finance companies. What if you could become your own source of financing? Like, what if you could control that 4-letter word, debt, and turn it into an asset? It'd be almost like, you ever done jujitsu or any kind of like martial arts? You've seen them, these guys, they'll come at their opponent, and maybe you grab that guy's arm and you can turn their force against them and actually leverage that problem into a solution. And that's what you can do when you've got the right tools and you've got the right mindset to not just be debt-free, but be better than debt-free. What's better than debt-free? It's sitting on the right side of the banker's desk. Most people are sitting on the wrong side of the banker's desk. And if you're not sitting on the right side of the banker's desk, you're going to lose the financial game, because all we can do is fiddle with the dials on our little airplane. But when you're sitting on the right side of the banker's desk, you get to control the environment in which your money lives.
Okay, so I know we're going to move into that part of the conversation, but I want to ask this first, kind of going back to my previous comment about what do we value and where do we spend our money and how we used to handle debt back in the day. I mean, the best I remember was we had layaway. Remember layaways?
Yeah, I remember layaway.
And then down at the corner store, you could write up a little tab. You could get up to about $25. And then when you had payday, you'd go in and pay off your $25 tab and you would start it for the next payday. Because that was the credit that people had back then, right? Which no wonder it was very controlled compared to what we have today. And it also was friend to friend in many cases. And so people were absolutely going to pay that back because that was their friend and they had made that promise and they weren't going to let it down. But I also think that, and I'm bringing this up because I see the parallel back in the day, I remember there was not this need for immediate gratification and immediate consumption. It was we have to work to earn it, not we deserve it because we're 22, or we deserve it because mom and daddy had it in their house, or we deserve it because that influencer told us or I deserve it because I went to college, or I worked hard, or I did ABC and XYZ, so I deserve. That's the mindset that we hear today. And when we hear it in our personal lives, it's going to carry over into our business lives. And I say that because here's what I've seen. I've seen people rob but have a lack. I'm going to back up before I say that sentence because it'll come off really harsh if I don't. They have a lack of their own financial business understanding. They don't even understand their own numbers. They don't know what the money is meant to do. They haven't given the money a job to do, right? They haven't parsed it out. You're to pay taxes. You're to do whatever. They see the money. It's kind of the profit first dilemma that we see. All the money sitting in the bank account, and they just start taking it. So what they've done, in essence, is they rob the company coffers to live a lavish lifestyle, to go on trips, to fix up their house, to do whatever, to pay a medical bill. I don't care what it is, but they took it from the business prior to when it should have been taken. And now the business is running lean and they're struggling. And it was the entire lifeblood to build their life. And they just destroyed the lifeblood.
The goose
right?
and the golden eggs. Yep. Mm-hmm.
Yep. And now they're like, they have that oh crap moment. What am I going to do? Right. Then you have those that have also borrowed because they've learned habits. We have learned habits over the last 40, 50 years. Just borrow, use the credit card. You can pay for it later. And by the time we're paying for it, it is consumed and gone and broken and in the trash, or we've given it to Goodwill and we're still paying for it. Right. And then we pick all that up and we move into our business. And I was sharing with somebody earlier today, whatever mindsets we have, worldviews we have, we don't separate it. from our home and our business. Because we don't, we walk from one place to the other, and we do the same things over here. And so we have as much consumer debt, I would say, on the personal side as the businesses. And that's why you're watching them just like fall, and you're watching them in a hard time. I remember 2008-9. There were a lot of businesses that closed down.
Mm-hmm.
It was a tough time. And if we're not prepared, we're going to be there again.
That's right. Yeah, the Gloria Steinem quote comes to mind. She says, rich people plan for 4 generations, but poor people plan for Saturday night. And I love working with every person that comes across our calendars here, but the people that I can see are going to make it are the ones that are ready to think long range. And if we're all we care about is I deserve this, or I, require that, then a luxury, once you enjoy it, becomes a necessity. And then all of a sudden our expenses will always rise to meet our incomes, no matter how much money we make. This is why millionaires can go broke, billionaires can go broke. Our expenses can always outpace our income if we don't give every dollar a job, which is one of the things I love about what you just said. So thanks, Michele.
Okay, so I'll tell you this too, and then we'll jump into that. I can remember my son. I think it was the youngest son. When he graduated college, he had been doing internships in his field for years. By that point, probably for 5-6 years, he'd been in that field. And he asked his supervisor at that point, he's like, what advice would you have for me as I wrap this up and I'm looking for my full-time position? He said, the best thing I can tell you is for the first few years, live like you're still in college.
That's right. Yeah.
He said, don't go out and say, I'm now making the salary and I'm going to go buy all these things. He said, if you can learn to live the way that you've lived very scrappily in college, he said, it will serve you well. And my son was like, he remembered that. And so both my boys, they did that. They lived very scrappy the first few years, but it's put them in a position to do other things later. Right.
Love it.
And we have to do the same thing in our business. Mm-hmm. We have to work. We do that. We work very scrappy, and then we make a little bit of money and we blow it.
That's right.
I mean, it's just human nature. So let's jump in then and talk about what it means to be on the right side of the banking desk, like on the right side, right? We're not going to be a bankster, but how do we handle that? How do we make sure that we do control the environment that we're flying our plane in? What does that look like? Not theoretically, but what does it look like in action, Mark?
Yeah, that's a good question, because we've been talking a lot of mindset here today, and that's good. You got to start with that. That's the head, the brains, the mind, the spirit is the most important, valuable asset you have on your balance sheet, is your own thoughts and feelings and mindset. However, we got to bring it down the ladder to actual practical strategy and financial tools that can help you implement the kind of world you want to create for yourself. And this is going to sound crazy. All right. I just got to say it up front. I was digging into my own financial goals. I was, again, ashamed of all the debt I'd accumulated, thinking it was the right move, graduating into a recession where I had no work, basically doing property management cleanup and just scraping by, just trying to make it work with my wife and all of us trying to bring all of our income to the table. I was trying to figure all that out. I also said, I want to get into finance, and I was working for a CPA firm. I was listening to the CPA. She was making those terrible phone calls in 2000. She was a great CPA, great at what she did, but she was having to make those calls. You know what I'm talking about?
I do.
Hey, Mr. Client, I'm sorry, I just lost you a third of your life savings or half of your life savings. I know you're 63 years old. I know you're about to retire. I can't help you retire. Whoops. That was a terrifying proposition. I almost left the industry as I was kind of just diving into learning about finance. And then a friend of mine, a mentor of mine from college, who's a professor of mine actually at the seminary, he brought to me this strategy called Bank on Yourself. And it made so much sense. But at first I was like more than skeptical. I almost turned to like, how do I help him get out of this scam he must be in, my professor? Here's what it is. It was a Bank on Yourself type whole life insurance policy, of all things. So it's a modernized form of dividend paying whole life insurance. Now, in my entire financial training, I had always been told, avoid whole life insurance like the plague. And I almost did. I had my eyes furrowed, my eyebrows were down, and I was like, well, this can't be real. And then he said to me, Mark, he looked at me right in the eye and he said, Mark, is it possible that Dave Ramsey, who was a radio professional financial infotainer at the time, and I listened to Dave Ramsey every day, my professor said, Mark, is it possible that Dave Ramsey could be wrong about something?
Right.
And my mind just blew open right there. And so the next 7 months, I dug into, is this even possible? So for those not familiar, I'll quickly explain what is Bank on Yourself and what does it have to do with your business. So in principle, I'll boil this down to a TGIF acronym. All right. Because I love me some acronyms. Maybe it's those preaching classes I took all those years ago. TGIF. Okay. So whole life insurance, it is a asset on your balance sheet. It's not term insurance. It's cash value, whole life insurance. The T stands for tax advantages and even tax-free income in the future. So you can use the cash value. Okay. The cash value is what you can spend on this side of heaven. The death benefit's there for when you pass away, but the cash value is your money while you're alive. And while that money is in your account, it's available with no taxes due if we designed it properly. So you can contribute whatever you want into a policy. In essence, it's like an unlimited Roth IRA in that regard. So no limits on what you can put in there. And when it comes out, it's income tax-free. Most people like to hear that it's a tax-free stream of retirement income because most people believe taxes are going up in this country. So that's a beautiful thing. Second, the G stands for guarantees. It grows on a guaranteed basis outside of the stock market, completely removed from the markets that have shown themselves to be more volatile now than ever before. And on a guaranteed basis, my money and my policy is going to hit a new all-time record high every single year. And there's really nothing we can do to stop it. It just grows contractually by the insurance company's guarantee. I love that. It's really refreshing to say, all right, on next year, my net worth will be this. 5 years from now, my net worth will be this plus this, and so on and so on. Third, it is life insurance. So I'm going to leave my family more than I could ever save for them. So I stands for insurance. And that's a nice feature because that's also income tax free. And then finally, and maybe the most relevant for our conversation for business owners, this gives us the ability to be our own source of financing. That's the F, financing. So you can become your own source of financing by using the cash value like a line of credit to yourself, where you can borrow against that policy, and the policy will continue to earn interest and growth as if you had not borrowed from the money. And to me, that was the wake-up call of my adult life.
That's the this for this, right?
Yeah, exactly.
Because even if you borrow from your 401k, you have to pay it back plus interest. Yep. Sometimes there are penalties. So, and you're not having any growth on what you took out.
Yeah. And there's even more problems with 401k loans, which we probably don't have time to get into. But I'll just say you pay taxes twice on 401k loans. And it's maybe the highest form of interest I've seen for the middle class. So be aware of 401ks. But you're exactly right. The closest thing I can compare this to is a HELOC. If folks are familiar with how home equity lines of credit work, your house grows even when you borrow against it. Zillow doesn't care if you have a mortgage, right? The Zestimate is the same whether you borrow from the house or not. The house grows as if you hadn't had the HELOC on the property. That's as close as it gets. Where does it break down? Well, HELOCs are still under the auspices of the bank's control. They can take away the HELOC from you. They can freeze the line. They can lower it. They can force you to pay it off. They can raise the interest rates on you. I'm seeing HELOCs at 11% right now, Michele.
Isn't that crazy?
It could go higher. Yeah, it's nuts. Nothing like that with whole life insurance policy loans. Loans are under your control. You are the banker for yourself. You can skip payments. You can pay a little extra, then go nothing. You can never pay off the loan. And if the policy's enforced when you pass away, they just deduct the loan from your death benefit. And meanwhile, the policy's continuing to earn interest and dividends as if you hadn't touched a dime of the money. So to me, this was how I paid off all my student loans. I didn't want to just be debt free. I wanted an asset growing for me as young as I could start growing that asset. So rather than waiting to start my saving until I was debt free, I started my policy as soon as I could, packed as much money in there as I could, use that money in my policy to wipe out all my debts. and I bought back my debt. I was basically my own banker, and I got to decide how and when I repaid the loan to the policy that I controlled. I was controlling the environment where my money lived. No longer were banks up in my face about it.
Okay, so let's talk numbers so that people understand. So theory, action, let's talk some numbers. In a situation like that, and let's keep really just some good round numbers. Let's say there's $100,000 that we owe. Okay. Student loans, medical bills, whatever it is that we owe. This is going to cost us 2-3 times the same amount if we pay them over the period, or forbid that we just pay the minimum payment, and then it's going to cost us 10 times what it was. Okay, if we were to move into this whole life insurance, is that what it's called? Did I get the title of that right?
Yeah,
okay.
exactly. Yeah.
This whole life policy. If we were to move into this whole life policy, would we then need to accumulate at least $100,000 in inputs into that whole life policy to then pull it out to pay off that debt? Or would we have to accumulate $200,000-300,000 in that to be able to have some to pull off? How does that part work?
So I actually trademarked this process. We call it the debt snowbank method. And we have some calculators for this. So the debt snowbank method follows several steps. Step 1, keep current on all your debts. Don't skip paying on your debts. Pay the minimums, but don't miss a payment, but just pay your minimums. Step 2, everything else that you don't have to pay on minimums or cover your lifestyle, throw into a policy that's maximized for cash value accumulation. We call it a bank on yourself designed whole life insurance policy. That's very important. It has to be designed the specific way to make sure that it does what we've just been talking about it doing. Step 2, we're throwing all we can into a policy. So imagine your debts are slowly coming down, 100 grand, 90 grand, 80, as slowly though, right, as you're making your minimum payments. Meanwhile, your policy is getting flooded with money. So that's growing very quickly. So you've got one pile of money getting smaller, one pile of money getting much bigger. Step 3 is when the policy's cash value is equivalent to your debt, or at least one of your debts. And you simply borrow against the policy and wipe out that debt completely. It's gone. All right. So that's it. Meanwhile, the policy continues to earn interest, even on the capital we borrowed. Beautiful. Now we're repaying the loan that we could to ourselves. Maybe that was $300 a month. Now we're repaying the loan to the policy we control and own. To answer your question, no, you don't even need to keep or accumulate 100 grand because your debts are still coming down while your policy is growing.
So you're doing it a little at a time to be able to get it there. And then it's kind of like what we even talk about in other forms of debt repayment. Then take that minimum payment and apply it, instead of applying it down, apply it over here so that you can take the bigger chunk out faster, because it's growing faster over here.
That's why we jokingly call it the debt snowbank method.
I love it.
And it gives folks the ability to have for me, it's going to be several $100,000 of additional wealth that I wouldn't otherwise have had I just paid the debts off the old fashioned way.
Okay. So now a couple of logistical questions. Certainly with any type of debt reduction, wealth generation, that kind of thing, the earlier you can do it, the better. Compounding, all that. We got it. But I am curious, is there a point, either age, life, money, is there a point that's too late to start a whole life? And then I'm curious on, is the money that you put in, has it already been taxed? So you're putting in after-tax dollars into that policy. Is that true on that piece?
Generally, almost 99% of the time, it's after-tax money that goes in.
That's why it's not taxed again later. Got it.
Correct. Yeah. Now, to answer your other question, no, we help folks even up to age 85 start these policies. And I'll just tell another story because I know you love numbers. I'll be brief about this one, but we just had a gentleman. He was a business owner and he was a real estate investor. And he did like syndication deals, multifamily deals, but realize you can use this in any industry, any industry with a large inventory. We work quite a bit with folks that are in the e-commerce space. I just got off the phone with someone who runs a 7-figure a year e-commerce business doing sports equipment, and it could work for them too. And if you're listening to this and you have inventory or large purchases, it would work for you too. But here's a guy, he's 65 years old. I'm looking at his numbers right now. He had the ability to put in $400,000 as a single chunk of money. just one lump sum. He didn't want to have he didn't want to hassle with having to pay a bill every month or every year. It's a single premium whole life policy. Drop it in. Right away, he has a cash value of $378,000. Wow. And his death benefit is $860,000, double what he put in. Remember, he put in $400,000, and he has now $860,000 for his family, should he pass away that year. But he doesn't pass away, thank God. Instead, he has his $378,000 cash value, of which he decides to immediately borrow within about 30 days or so. He borrows out $360,000, which is how much he wanted to put toward a real estate deal. All right. So far with me, everything making sense?
I
Any
am.
questions so far?
He
Okay.
put in 400. He's got 378 cash value. He's got 800 plus as a death benefit if he were to die. And if he were to die and he's taken out this 350, then it's going to be the 800 minus the 350. His family's going to get 500 and change.
That's it. Wow. You're a fast learner, and I can tell you love your numbers. That's great. 8 years later, he'll have paid off his loan through a refinance or selling the property he purchases. Okay. 8 years later, his cash value has now grown from $378,000 to $507,000. Now remember, he put in $400,000. It's grown on its own with no market risk, even though he'd borrowed out all of that money and then ultimately paid it back. He now has a cash value in year 8 of $507,000. That's $500,000. And his death benefit has grown to $912,000. Now that is a powerful tool for operating your business. He paid a little loan interest for that. What's the catch here? He paid some loan interest. Okay. He paid over that period of time. His APR, his annual percentage rate was 2.1% to borrow from the insurance company. 2.1%, $54,000
compared
is
to
what
11
that
for a HELOC that you've seen.
Exactly.
Yep. See, I remember that too. Yeah.
Well done. Yeah. But remember, his policy he may have spent $50,000 on loan interest over that. If you do the math there, that's about $54,000 of loan interest. I know I'm throwing a lot of numbers on a podcast.
Okay.
Forgive me. Last number is, he earned $107,000. He put in $400,000. It went up to $507,000. That's $107,000 of growth. He only spent, whatever, $50,000 or whatever in policy loan interest. This means not only did he get the rental properties, the multifamily deal, all that real estate fund stuff, the tax advantage, all that stuff, but he also got like 50 something thousand dollars of arbitrage. That's the fancy word for you earned more than you spent. And he controlled the environment in his banking for that 8-year period. Like, what if this was a recession and no banks were lending? How could he buy that multifamily deal? When you have the bank, you control the whole card table, right? So to me, this is, imagine how this would work in most every business. Any business that has inventory, any business that pays their taxes. Why would we pay taxes out of a savings account when we could use a policy to do the same? I just took a policy loan to pay my tax bill, and I use Profit First, and I use my policies as my vaults for my taxes and my profit hold and all these different accounts.
So that it's growing for you while you do it. Okay,
Exactly.
So that leads me to two other questions, because I'm loving this. So here's my next question. When we take this out, do we take it out as a company? So then it becomes, like you said, it would show up as an asset on a balance sheet, or can people that are listing also potentially set one up personally? So there's a personal version and then there could be a company version.
It can be either one.
Okay. And then my next question is, you talked about, I think you kind of glanced over it when you were giving your example. So I'd like to dig in a little more about the gentleman who was able to fund it with $400,000 one time. Here we go. What about for those that don't have that, but they have? So what are the funding options would be a better question.
You can start with a couple $100 a month, $300, $400 a month. You can start it with a lump sum once a year. A lot of folks get that bonus where they have a good Q4. Every quarter, every Q4 is a good quarter. So they're going to dump that in once a year. $5,000 a year, $300, $400, $500 a month. That's about the minimum for most folks in the Middle Ages. Or as much as you'd like. Lump sums can go up to millions, per year.
So when you start one of these, is it that, I guess what I also want to know is, for the listeners, would it be like if I said, all right, I'm going to give I'd like to do 500 a month. Am I locked into 500 a month, or is there a threshold that I can get to that I can be like, oh, life is tough. I don't want to have to take a loan so that I can give you the $500 back. Like, how does that work?
Think of these sort of like gas tanks, and I'll keep this analogy brief, but imagine you got a car that can hold 12 gallons of gas. You can run your car just fine on 3 gallons of gas, no problem. Won't go as far, won't be as efficient, but it runs just fine. You can do that with a policy. If 500 is our target, then you can usually lower it down to, I don't know, let's say 200. And you can lower it down, you can raise it back up again, just kind of like your gas tank. You don't have to top it off every time you go to the gas station. Now, some folks say, well, what if I can't even cover that 200? Well, then we've got a few other options, which probably exceeds what we have time to talk about together today. But you don't want to jump into this beyond what you can manage. Start with what you can, grow from there. My first 2 policies were fairly modest, but it was as much as I could do at the time. And then as our income has grown, we've increased our portfolio. We've added several more policies, and we haven't looked back.
All right. So then that tells me that there are options. And I love that. Don't bite it. That's what I was trying to get at. Was it that you're making a commitment for your whole life to give this amount of money to here, unless it is here's a lump sum for this particular policy?
Yeah, I'd say whole life. You can stop funding these 5 years in, 6 years in. You don't have to go to your deathbed funding this thing. You can retire when you're 62 or 72, or you can fund it for 3 or 4 years, 5 years, and be done. Most folks do try to fund it over a long period of time because they know it gets more efficient the longer they can fund it.
Okay. For some, one policy may be sufficient. For others, there may be a need for multiple whole life policies that then at the end of your life, it would be a payout, a payout, a payout, a payout, a payout. And can 2 people go into these together? Like some of the businesses or partnerships or things like that. Can whole life be set up that you both own it together and you put, especially business wise, right? You put it in together.
All kinds of creative solutions for the business where the partnership might own it together. It's always going to be tied to one human life, of course, but that's just the insured person. It could be a special sales gal on your team that you insure, but you are the owner of that policy.
Okay, perfect. Oh my gosh, this is such great information. It's got me thinking on a lot of things. And so I really appreciate that. As we go to wrap this up, Mark, is there anything else that you want to share with people as they're like absorbing this, listening to this podcast 4 times with a calculator? Is there any information that you'd like to give them that would just even help them figure out, am I interested? Do I want to know more about this? Because I'll tell you, the questions that I get, and I'm sure you get them, but with the industry that you serve, but I get this a lot, especially the companies that I work with. Michele, we're generating a lot of wealth. We're generating a lot of money. How do I protect it? I mean, I'll pay the taxes I have to pay, but how do I protect it? How do I save it? And how do I have it work for me? Like, it's not worth having, because we're doing vaults. We're doing, 3 to 6 months of savings. We're doing so we can borrow from ourselves. I don't want to have $200,000 just sitting in a 2% interest bearing account with the bank. I don't want to do that. So how do I save this, but also have access and so that it's usable cash? It's not tied up in some 5-year CD that I can't touch. What do I do with this? And this is definitely an option for that.
I'd say you're exactly right. The best thing you can do for free as we wrap this up is figure out what you want your money doing for you, and then forget about the labels, forget savings account, forget whole life insurance, forget 401k, get rid of the nouns and just focus on the verbs. What are the functions or attributes that you want your money to act like and do for you? Because if you're not demanding your money act a certain way, it's going to force you to act a certain way. And I'd rather see you working your best life and letting your money work for you rather than your money telling you what to do. So figure out what you want your money doing for you, make a little wish list, and then happy to reach out to me and happy to speak with you about any of the strategies that we've talked about together today. All right. Best way to reach us, if you're sick and tired of being pulled on by the bank's puppet strings, or if you're tired of the market giving you some mayhem, you can reach out to us. We can help. You can go to kickstartwithmark.com. And we'll do a 15-minute phone strategy session. We don't bite. We're just going to ask you some questions, get to know you a bit better, and see if this tool or similar tools would be a good fit for you, that's kickstartwithmark.com.
Awesome. Well, thank you so much. We'll put all that in the show notes and make that available for everybody. And there was a book that you mentioned, Debt, the first 5,000.
Oh, yeah. David Graeber.
Okay. We'll put that in there too. Awesome. Well, you gave us a lot to think about and a lot to consider, and we really appreciate your time with us today, Mark.
Thanks, Michele. Thanks for having me on.
My pleasure. Mark, thank you so much for joining us today. It was such a pleasure working with you and talking to you. And for those of you that are listening, I want to encourage you to check out what Mark has. Go to the website, listen to his podcast, just check out all the things. And if you are looking to strategically build your business, create a framework for thinking and decision making, or maybe you're looking at, I need a strategy and I need to just understand where I am financially within the firm, give me a call. Go out to scarletthreadconsulting.com. You can sign up for a discovery call. Let's just dig in and see where you are. What are we working with? It's so hard to make a plan to get out of where you are if we don't first know where you are. So let us help you do that. You can also join us at matriquesolutions.com, financial dashboard, put your numbers in and let it tell you what your money is doing and what your financials are doing. So today has been all about taking back control. And I want to encourage you to do that because if you own it, you can change it. And that's the beautiful thing about profit. We're building it. And I want to encourage you, build a company that's profitable because profit doesn't happen by accident. Profit is a Choice is proud to be part of the designnetwork.org, where you can discover more design media reaching creative listeners. Thanks for listening and stay creative and business minded.